quite fortunate to sit with the three esteemed panelists over here, representing different asset classes within alternates, real estate, private equity, and structured finance. Ruben is very, very well known, one of the guys whom I respect a lot. So Ruben, thanks for being over here.
Thank you.
In fact, our industry is going through a huge shift. Alternates is the biggest buzzword. There are certain tailwinds, whether it is around the GDP growth rate which India is seeing. Also, financialization of savings, people moving from physical assets into financial assets. Within financial also, people are moving from contractual savings or fixed deposits into market-linked securities. And within that also, HNI pool is growing at a rapid pace. HNI growth is what, 16%? And India's population growth is 1.5%. And Anil showed in one of the presentations how people above $35,000 will shape up over a period of time. So these tailwinds, if we just put this math together, this segment is going to see about 30% growth rate in next 10 years, which means 2035, the size of this PMS of alternates will become, 11 times. And I'm sure all of you look very young. You would be in your, 30s, 40s? 40s? So let's say if you have a career for about another 20 years. So if 11 times is the growth in next 10 years, and maybe 7 to 8 times, so maybe 75 to 100 times growth you will see in this career. So I'm very happy, lucky to sit with this esteemed panel who is going to see such a phenomenal growth. So let me just start with a few common questions, and we can go maybe in this order. Akshat, first of all, to you. In this highly competitive landscape, how does each of the product segments differentiate itself from the peers?
So the way we look at this space is, I think it's a function of the risk reward matrix, right? At the end of the day, it's very easy. Everybody wants the maximum possible returns with the least possible risk. It is where do you find the balance where that ratio of risk to reward is in the favor of the investor / the fund manager, or like I say, there's a disproportionate ratio to that extent, where with the relatively or visibly lower risk you can deliver higher returns, right? And right now when I'm talking about the unlisted space, right? The listed markets have been phenomenal over the last 3 years, and there are a lot more experts, a large number of experts here who speak about that. So specifically from at least the real estate space, I think the maturity of the entire space over the last 20 years is something which is very visible. I think now the investors can actually take exposures across the entire cap stack, depending on the kind of risk that they want, from as low as single-digit returns in your REITs all the way up to your special sits going into the mid-20s. So I think the key part that we look at is that the matrix has to be disproportionately in your favor for differentiation.
Tarun, you spend most of your time on the private jet, like the way Mark Mobius spends. So he keeps flying. I asked him, where do you stay? He stays in the air, but very grounded. So Tarun, how do you...
in Indigo more than a private jet, but that's fine.
Yeah. So how do you look at this competitive landscape? And
so and just for background, so I run the healthcare fund at 361 Asset Management. And the way we differentiate our offering is really broadly at 3 levels. I think the way we approach healthcare investing is from an angle of really having specialized expertise in that space to find the best assets as a part of our healthcare portfolio. And that expertise is, of course, comes through the team. I've been doing healthcare investing for 20 years and, done a lot of pioneering companies like the first infertility chain, the first dialysis chain out of India, and so on. But more important than that, what we have done in our fund is that we have gotten super successful healthcare entrepreneurs to come and partner with us and become our anchor investors and invest alongside us. So these are the folks that have come in from hospital services, from diagnostic, who have run diagnostic chains, who have expertise in healthcare, health tech, in API, in complex generic manufacturing, so covering all the segments. But through them, we have this whole access to their deep understanding of that space, market intelligence, and that allows us to really make very smart investments in that space. The other way we differentiate is just the power of our platform. So 361, of course, we are a $4.5 billion listed market cap company. So the quality of governance, the quality of oversight, risk management, portfolio management that you get is best in class. So that's a big support, comfort for any investor considering starting their journey in alternates. And of course, you refer to the number of HNIs increasing. 361 has the largest network in that space. 7,000 odd families, richest families and wealth creators and entrepreneurs in India trust us with their capital. That gives us a lot of opportunities for partnership. And it's a very deep relationship. It's beyond a transactional investment banker kind of relationship. So that's the second differentiator. The third one is really our track record. I mean, we have $3 billion of our assets under management across strategies. But we are most proud of the fact that we have generated great returns. $2 billion have been returned by a private equity team over the last 7-8 years. And our track record in healthcare is also super strong. We have made money in single specialty hospitals, in pharma CDMOs, in regional hospital chains. So a combination of these three really helps us to sort of showcase our capability and stand apart.
Yeah, Ruben. So thank you, Himanshu. Thank you to PMS Bazaar to have me here. See, in addition to what Akshat and Tarun said, maybe I can also add a little bit more specific answer. See, I represent a special situations credit fund. Credit may, so obviously equity is one pool, credit is also one asset class. Credit may broadly, you have, in alternate credit, you have something like a venture debt, you have something like a performing credit, and then there is a category which I represent, which is a special situations credit fund. From a competition perspective, investment landscape, why we have chosen this particular niche is in a country like India, with a 3.5 trillion, say, market cap, GDP give and take. Annually, there is always like a 1 lakh crore kind of deployment opportunity in special situations credit. And there are many situations for which banks, NBFCs, traditional funds cannot cater to the needs of the mid-market in India, which is special situations credit. So, give and take, 1.25 lakh crore ka requirement always hai. Right now also, I'm always sitting on a 20-25 deal pipeline. The funds catering to this kind of needs are very, very handful in India. Mid-market private credit, there are a handful of India. So, capital chasing these opportunities on an annual basis would not be more than 4,000-5,000 crore. So 4,000-5,000 crore capital is chasing opportunity, say, of 1 lakh crore plus. So risk reward wise, demand supply wise, this is a very, very attractive niche market that we are targeting. And just to give you, we have now done 18 deals from the fund, and 18 deals करने के लिए हमने 400 companies देखी है in the last 2 years or so. So basically, from a demand supply wise, we are very, very, in a niche space. This is not a space where easily anyone can set up teams. This space requires serious pedigree, requires team which is senior, which has gone through ups and downs, which has seen cycle. So it's not like कि भाई किसी 2-4 लोग को उठा लिया NBFC से और team setup करके बिठा दिया. This team cannot, this space में you cannot do that, and you can't even raise money. So thankfully at Neo, we have the pedigree. We are the senior most team in the market, and we are able to do that. So long answer to your question, but that's how I see the demand supply in this space.
Right. So you mentioned there is far more demand than the supply over here.
Correct.
And we are all followers of Warren Buffett, who has compounded the wealth at a reasonable good rate. He has lived till 93, 94. As a result, he is the 6th richest person in the world. So it's clearly the 8th wonder of the world. So IRR is something which is very close to our heart. So, Ruben, I come to you. What is the typical IRR for your product, and how can investors use this metrics to assess the attractiveness of this opportunity?
Got it. So again, rather than giving you generalized answer, I'll give you specific answer which we are
And
actually delivering.
I would prefer specific answers only from all of you.
तो हमारा करीबन अभी 2600 करोड़ का फंड है. We have deployed 75% of the fund. So this is a good enough metric and sample size. We have deployed about 1800 crore across 17 companies. Right now we are delivering a 23% gross IRR and 20% net pre-tax IRR in the hands of investor. So that's currently what we are delivering. And there is a proof of the pudding, because out of this 20%, 18% is an annual cash coupon, or 4.5% quarterly cash coupon is what we have been delivering to our investors consistently in the last 18 months. So that's maybe a very specific answer to your question.
Yeah, and that's the reason I said he is one of the most respected credit managers in the country.
Thank you. Thank you.
When I started it. So, Tarun?
Sure. I think the way we construct the healthcare portfolio, our approach is as follows. So we typically, at the growth stage, we come in at a valuation discount of anywhere between 30 to 40% to what a late stage or a large asset would be valued at. On top of that, since we come in at a relatively younger stage, it's still a growth stage. So it's not like it's a company which doesn't have revenues and so on. There's still 100 crores of revenue, in some cases 100 crores of EBITDA. But because they are relatively younger, we can underwrite growth from that point onwards to say a 35%, which allows us at an asset level to underwrite an IRR in the range of 35 to 40%. Now, of course, conservatively, not every asset will hit that number. At a portfolio level, you want to generate a 30% IRR. And then you apply the fees and carry and so on. The idea is to still deliver north of 25% net IRR to investors. That's the IRR. But the other angle I would like to add here is that this IRR is super stable, because a healthcare space is not affected by a lot of the macroeconomic shocks that you might see. If the interest rate goes up or down, there's no impact on it. If, whatever happens in US elections, Indian healthcare will keep on growing. Whether there's a Middle East war, it doesn't get impacted. So the resilience and the stability of the sector is also key when you are looking at the IRR of the healthcare fund in particular.
So for us, our strategy, getting to specifics, is we've identified this area where, we significantly reduce the risk, because as all of you all may know, real estate is a very, cyclical as well as very micro market specific, underlying. So we, come into investments post-approval. We, do about half a dozen other things which significantly reduces the risks. We've, I'm very happy to say, for the last 8 years, one of the few real estate funds in the country where we've not had a single default or a single delay, through all the ups and downs of COVID, post credit crisis, all of that. We also give a quarterly coupon, which we've consistently again given for, more than 7 years. So, that relating back to my first answer, I think it's a space where we believe where we can consistently deliver irrespective of the cycle, because our entire return comes from the development margin. We don't need the prices to go up a single rupee to deliver this return. And in terms of numbers, we've delivered about a 17.4% gross at the portfolio level across all the investments and this is over a 8-year period that I'm giving you the number. So, that's the return.
So 17%, 25% pre-expenses.
No, net of expenses.
Net of expenses, 20%.
23 gross.
23 gross, 20 net.
Yes.
So Tarun, you manage the healthcare space. It's one of the most dynamic industries. It's constantly evolving with new technologies and market entrants.
Mm-hmm.
How do you maintain your competitive edge, staying ahead of emerging players and adapting to shift in market dynamics?
Yeah, so I think the good part, the great part about healthcare, I feel, is it's relatively a stable industry. I don't see situations where somebody comes up with a new technology and changes the course of a particular therapy and so on. Regulatory approvals take time. in healthcare. We have all worked with doctors. We know how cautious they are. They are not going to try new things, new therapies, new devices, new medicines overnight. It takes a lot of time to change an existing setup in healthcare, which is a great play for us, because if once we come into a company that's scaled well, they can be either providing a specialized therapy with nobody else's, like we invested in infertility 8-9 years back, or you may be actually improving the current standard of care. So for instance, most of the CT scans, X-rays that get reviewed today are read by radiologists manually. We are investing in a company that uses AI to augment that at a very large scale. So that's improving the current standard of care. Or thirdly, you can just improve the clinical outcome. So for instance, I've invested in a company in the past which is using radiotherapy to treat tumors and giving much better results. But if you're using these, you're really creating a massive change by having better standards. Then it's very difficult to dislodge you, because any guy who comes in at that point, he has to have the clinical protocols right. They have to get the regulatory approvals. It takes a lot of time. So hence, a lot of the disruption, or at least the risk management there, happens in coming into the company at the right scale, but which is actually differentiating on the basis of science and better quality of care. Once you do that over the next 3 to 5 years, which is our horizon, it's very difficult to disrupt those guys, because then it's just a growth rate that they keep on compounding.
At what stage do you enter the company?
So we have a dual approach. We have an early growth entry point where the companies say 100, 200 crores of revenue. And we have a late growth entry point where the company is 100 to 200 crores of EBITDA. But we don't come earlier than that. So at both those stages, it's validated at a decent scale, their science.
Akshat, let me come back to you. You mentioned about not even a single default in real estate sector, which is very rare to hear, because North India तो हम सारा time default से सुनते रहते हैं यहाँ पे. Commercial and residential real estate both offer distinct risk return profiles.
Yep.
How do you assess and differentiate between these two opportunities, and what drives your preference for one over the other?
Perfect. So I'm going to club that question with the general feeling in the audience that I got about allocation to these strategies and their past experiences as well. So at no point, will we ever say that, remove your equity allocation and put it here, right? If there is an allocation, what we're trying to provide is an alternative for the debt side, a small portion of that which can deliver consistent returns and significantly higher returns than your fixed income, whatever is forming part of your fixed income, current allocation strategy. Coming specifically to the question, I think, so the underlying cash flows define the structure. So what exactly is credit, right? I'm sorry, I'm taking a step back. It is obviously selecting the right underlying, but it is the structure that you create around it. So just to give you an example, a same project with the same developer developing the same project can turn out to be a great credit investment or a very bad credit investment, depending on the covenants, the veto rights, the structure that, the amount, all of that you created, the controls. I think that portion right now is never, emphasized enough. So I think now if you look at the industry, I think there are clear segregations. So if I take again an analogy from, the mutual fund space or any other investment, how do you judge that a fund and a fund manager is doing well? The same matrix should be used. Past track record, amount managed, what have you delivered? Now, all of that with, this industry being 20 years old is very readily available in the market. So specifically coming to the question again, if you look at commercial, your cash flows are all back-ended. You develop the property, then you lease it out, rent it out, rentals come in, and then you kind of, get your return over the years, as opposed to if you're actually doing a resi or any other development part where your cash flows keep coming throughout the development, your risks are very different. So obviously, the commercial space in India is already, kind of overcrowded with some of the large boys like Blackstone, Brookfield, GIC already taking huge, exposures, limited availability of grade A space, each project size requiring thousands of crores. So that space, purely because of where we are in terms of, our stage of evolution, we're not currently focusing on. Whereas if you see the credit space that I'm talking about in the sector, there is no large organized player. And again, taking a leaf from Ruben's book, where he said this anomaly, right? Why can we give 17% returns where the underlying risk is 10 to 12% risk, is purely because of this mismatch. The annual deficit, as per a couple of reports by Anarok and JLL, in this space, real estate space, for funding ranges between 40 to 60,000 crore, the deficit, not the requirement. The requirement ranges from 140 to 160,000 crores, against which the capital annually chasing it, especially from the funds of this credit space, is a few thousand. So it's because of this anomaly, fund managers can cherry pick, take these investments and give these, again, the risk adjusted return, right? So if you are getting equivalent of, AA risk is what I'd like to put it as, and getting a 17% return, if it was any other sector without the baggage, people would be falling over each other to get exposure to it. But that's the unfortunate anomaly that we live in.
Yeah. Ruben, I come to you. Are there any specific sectors or industries where you see more special situations arising?
Strong.
Right. So sector-wise, see, the demand is from all the sectors, I would say. Rather, the way we operate is we avoid certain sectors. So, for example, and sorry, Akshat, but my expertise is it's a good sector, but my expertise is not there. So, because real estate needs a lot of expertise, so we avoid real estate from our fund. Again, it's more about expertise, not about anything else. Any sectors which are very cyclical, we avoid them because ours is a short duration fund. I don't want to get caught in a bad cycle. And similarly, कोई low value commoditized धंधा है तो उससे हम दूर रहते हैं. See, ultimately what we believe is कि धंधे में value है तो promoter will also behave. अगर समझो business का genuine value 1000 करोड़ है, debt 300 करोड़ है, तो promoter sees कि भाई मेरा 700 करोड़ का skin in the game है, he will behave with you. अगर business का value 300 है, debt भी 300 है, तो आप कितना भी security कुछ भी हो, promoter बोले यार चाबी ले लो आप यार, beyond the point, very practically. So that's how we think about it. जो सेक्टर में जो बिजनेस में वैल्यू है, लाइक कंज्यूमर हो गया, हेल्थ केयर हो गया, मार्केट में लिस्ट करने जाओ, दैट्स अ वैल्यूएबल बिजनेस. So we like to see those sectors के भाई वैल्यू है एंड हमारा डेट कंपेयर टू द वैल्यू ऑफ बिजनेस इज लिमिटेड. तो प्रमोटर ऑलवेज फील कि भाई लेट मी बिहेव विथ हिम, लेट मी बी ऑनरेबल विथ हिम. इफ आई मेस विथ हिम, डिफॉल्ट हिम, तो मैं अपना वैल्यू भी बर्बाद कर दूंगा. That's how I think very practically. So to answer your question, these are some sectors we avoid because one we don't understand and because they are cyclical or low value. So that's how I think about it.
And which are your favorite sectors from special situations point of view?
So see, niche manufacturing, industrials, hum typically, we like to work with 2x, 3x share collateral cover. So again, asset light sector में वही problem होता है कि assets नहीं ज़्यादा, promoter can always, do business in some other entity, etc. So धंधे में अगर assets है, like some of the deals we have done, for example, we funded one steel company in Vizag. It's got 400-acre land. It's got like a fully integrated steel plant. It's got 60-megawatt power plant. Railway siding है, port के बाजू में है. So strategic value बहुत है इसमें. And we are the only lender where we have more than 1,000 crore of assets for a 275 crore loan. So those kind of deals we like and those kind of sectors just to like.
So maybe after the session, we'll also have a vote. Other than giving majority of the chunk of money to Anil or Iqbalji in equities, which asset class would the audience sitting over here like to allocate their money? So we all spoke about returns. That's one R which is very important, but the other R is equally important, which is the risk part of it. So risk management is crucial in today's volatile markets. How do your respective asset class, which is private equity, real estate and private credit, help mitigate portfolio risk, and what specific risk management strategies are you relying on? So maybe I'll go with you first, Tarun.
Sure. So I think at the portfolio level and particularly in healthcare, there are three broad classes of risk the way I see it. One is, of course, the governance risk, that whether the promoter or the entrepreneur is doing the right things for the patient and, following the right medical, legal, ethical practices. So for that, it's very important when we come in with the eyes open, do very thorough forensic diligence. But a big advantage comes from the advisory board that I referred to, which have experience across all the spaces. So we use them and engage with them, even when we're doing the operational diligence of any of these companies, to figure out, are these guys administering the therapy correctly? Is there any potential for cash leakages? And where can we stop that? So that's a big part of governance risk that we oversee very closely. And that comes in with our overall compliance practices and risk management that goes with it. The second big risk is really around performance, which, we are in the business of taking risks around performance, around execution. So the way we try and manage it mostly is by being super conservative when it comes to valuation. So in our entry valuations, and I referred to it earlier, are at a marked discount to what a large scale company, or when we exit, is what we expect to get. And that bakes in a little bit of the execution risk that goes in. And then of course, the work that we do, because we always take a board seat, we engage closely with the entrepreneur, we can do course corrections when we see things not working out. So a lot of the performance risk gets managed through that. The last and the most important risk also is the exitability risk. Are you able to exit that investment in time and at the returns that you want? And that's where we end up having an approach where what I referred to earlier is having some early growth investments, which are companies which I want to hold on for 5 years, because that's the kind of scale I see it can compound over 5 years. And some of them are really younger companies, younger exit timeframes, which means they are scaled up. They're almost, like I said, 200 crores in EBITDA. The exit period may be around 3 years there. So when we plan for our whole exit horizon, we also make sure that the returns are not all back-ended. I can start giving returns much earlier, and that's how the liquidity risk also gets solved for. So those are the broad parameters we look at.
Akshat, what about you?
So obviously real estate is one of the riskiest asset classes.
आपकी आवाज आस्ते हो गई है risk के बारे में.
No. I thought if I scream about risk, it will not sound right. But so absolutely right. So real estate is going to be risky. It is going to be cyclical. People will lose money if they continue with the same practices they have that were followed earlier, right? So, but at the same time, the sector, because of the difficulties, there is an entry barrier, and not everybody can come and become a DLF or a Shobha or a Oberoi. There is huge development margins and huge wealth creation opportunities. So the question that comes is, how can you tap them consistently? So again, our strategy, I'll quickly sum it up in a minute, is again, the entire question, which I think unanimously everybody's asking, is how do you reduce risk and how is it mitigated? We don't take approval risk. We come into projects post-approval. Approval timelines are in nobody's hands. We make sure that the execution is less than 4 years or below. We don't do 2 million, 3 million, 5 million, because it'll take longer than a cycle. We take 100% control of the bank accounts, because this is the only sector where you have to assume the promoter will take capital out if you don't control it, not the other way around. So on all RERA accounts, we become sole signatories. Every rupee, including construction, is controlled by us. We make sure that the underlying product is something which sells consistently. So we don't do uber luxury. We don't do affordable. Affordable has no margins. Uber luxury sales are very sporadic, right? With all of this, you still need to have your basics right. They sound boring, but that's what gets us through difficult times. So low LTVs, we never exceed 50. It is one of the only sectors with hard security with you. If your capital structuring is correct, you will never lose capital. The only time you lose capital is either you're taking title and approval risk, where you don't end up getting the land or the FSI that you could develop, or you have kind of taken a mezz or an equity position where the senior debt eats away the entire margins and you get left with nothing. Otherwise, to lose capital in a senior secured credit position in India, that is difficult. So, all these things that I'm talking about, we've been doing for 8 years. It is not theory. And like I said, again, one of the only houses, let me stick to a few in case there are some that I don't know of, in this space, which have 0 defaults. So it's something that works. I think that's the larger confidence that we're trying to build, because people still like real estate. It is that people are scared, and I think they rightfully should be. you can lose capital if you don't know what exposure you're actually taking.
So what I heard is you don't do super luxury.
Yes.
You don't do affordable also.
Absolutely.
So आप करते क्या है?
Mid-income, upper mid-income, which is the entire space. So
Which one?
Mid-income and upper mid-income.
Okay.
So effectively, as an example, in Mumbai, because the market, so a 3 to 5 crore is the upper mid-income house. It's not,
Luxury.
super. So super luxury normally we define by size, right? If you're going to take a 4,000 plus square foot house, it goes into super luxury. So the price per square foot may be high in certain areas, but as long as it is real end user demand, right? Because people need houses, people want to upgrade lifestyles, they want better amenities, societies that have, from little paddle courts now, otherwise you've not made it. So stuff like that, people are going to upgrade, and we're seeing this, upgrading houses is a major theme, especially in the last 3 years. So anything that end users buy, we can get our arms around in terms of demand. Anything that is investor driven, and unfortunately the markets in the north have the highest investors, very hard to gauge, because an investor will flip the moment the cycle turns or he's not making the returns, and then you're left holding the, so that's what we try and avoid.
So from a risk management, I'll give a nuanced answer. The way we think is two level, portfolio level, because ultimately I have to think of the entire portfolio, and individual deal level. Portfolio level, most important what we do is single party exposure should not be more than 5-6%. So I have to have minimum 25 deals in my portfolio. एक आध भी मेरा deal खराब होता है, it should not impact my fund IRR by more than 75 basis points. 0.75% से ऊपर impact नहीं होना चाहिए. This is very important. I'll just take few seconds. 5% मेरा single party exposure है. The way we operate, we take 2x, 3x security cover. हम हर डील में प्रमोटर की पर्सनल गारंटी, वाइफ पर्सनल गारंटी, मदर, उसका शर्ट पैंट सब ले लेते हैं एवरी डील. सो बेसिकली 30% के ऊपर नुकसान नहीं जाएगा मेरा, बिकॉज ऑफ ऑल द शेयर कवर एंड कोलेटरल कवर दैट वी हैव हार्ड एसेट्स. तो 5% मेरा सिंगल पार्टी एक्सपोजर है, 30% मेरा खराब गया उसमें, तो 1.5% लॉस हुआ. वो भी फर्स्ट दिन पर नुकसान नहीं होगा, बिकॉज अनलेस इट्स अ फ्रॉड सिचुएशन. तो 2 साल भी डील चलता है, माई पोर्टफोलियो इम्पैक्ट विल बी 0.75%. If one deal goes bad, if 2 deals go bad, it will be 1.5%. So that's why this single party exposure is extremely important. And we are very, very finicky and sensitive on the single party exposure. Diversification, we will have minimum 12-13 industries. India mein a lot of randomness happens, a lot of sectors can go down because of regulatory issues, this, that. So single sector पे ज़्यादा exposure नहीं लेते हम लोग. And number 3, short tenor deals. 18 महीना 2 साल, उसके ऊपर डील नहीं रखते. 20-22% वो मुझे 4 साल के लिए चुकाएगा, तो वो भी मर जाएगा, मुझे भी साथ में ले जाएगा. So I keep my deal tenor very short, 18 months, 2 years. So that's how we think about portfolio risk. Maybe
Per company or per exposure is limited to 5%.
5-6%.
5-6%. Per sector is?
Per sector, generally right now I'm not exceeding 10% in any sector in my part.
Okay, so at any point in time you'll be looking at about 10 sectors.
Yeah.
Okay, so Ruben, coming to you, special situations. Investing is all about identifying opportunities others may overlook. How do you spot this distressed or turnaround opportunities? And what's your strategy for ensuring they deliver attractive risk-adjusted returns? So part of it you have covered in the previous one. But yeah.
Without sounding little cocky, what's happening is in this there are just 2 funds in mid-market special situations. In the whole country there are only 2 active funds. One of us is that, our fund. We generally, deals are coming to us because there are so many special situations across India, across sectors right now. Without doing much effort, we are sitting on 20-25 deal pipeline at any point of time. So our job is actually to pick and choose and ensure that we are not going overboard in any of the transactions. ऐसा कोई turnaround call, risky call, leverage call, मतलब कोई cowboyish call नहीं लेना हमको. Simple, straightforward जो हमारे metric में बैठता है. That's how we think about it.
So my last question, Akshat, real estate is a very interesting sector. No defaults happen from your side. How do you ensure there is an alpha which is created, and how do you ensure liquidity is provided?
So real estate is only about managing liquidity. If you look at hard asset cover, anybody, any loan they've always done has enough hard asset cover. Where they get stuck is if it is not monetized quick enough and returns generated, which is developing and selling, that is what starts eating into the margin. So for us, the product being a constructed immediately and sold immediately, because those are the only two risks we are taking, and the monitoring around that is absolutely critical. So we have technical teams, we've got everything going in, out, every week we control the cash flows. Like I said, we have sales, milestones. As long as it sells and it's constructed, you will get your money back very comfortably. So I think that is, again, it's basics. There's no rocket science. The challenge is people have not been doing it. They leave it to the developer to be prudent, which I think there are enough cases that they haven't.
Right. There are other list of questions which I prepared, but keeping in mind the screen, it's showing time's up. So thank you, gentlemen. Thank you so much, Akshat. Thank you, Tarun. Thank you, Ruben.